This is the Capitalism and Freedom, the 21st Century Podcast, an official podcast of the Hoover Institution Economic Policy Working Group, where we talk about economics, markets, and public policy. I'm Jon Hartley, your host. Today, my guest is Cliff Asness, who is the co-founder and managing partner of AQR Capital Management, a quantitative investment manager. Cliff also has a PhD in finance from the University of Chicago Booth School of Business, where he studied under the Nobel Prize winner Eugene Fama as well. He's here to talk all about asset pricing and financial economics. Welcome, Cliff.
Thank you, John. Thank you for having me.
Well, it's a real honor to have you on, and really want to get into start with getting into your early career. Where did you grow up, and how did you first get interested in economics and finance?
I was born in Queens, New York. At 4, we moved out to suburbia on Long Island, and I grew up in post-World War II suburban housing out there. I was not interested in finance for a while. I was kind of a only half engaged high school student, mediocre grades, good boards. Ended up, my father found this program at the University of Pennsylvania where you got a dual degree. You got a degree from the engineering school and from the business school. He said, you should do this. You have no clue what you want to do, so study 2 things. That was about the depth of it. I went there. It actually was not me. I was not a young, read the Wall Street Journal, trade stocks at the age of 7. It wasn't until I took 1 or 2 finance classes as part of the Wharton curriculum that I was like, this stuff's pretty cool. So I got interested in a very boring way. I took the classes and liked them. Though my dad, again, influenced my career a lot because I had always assumed that even though I was studying 2 fairly mathematical topics, that I would go to law school because my dad was a lawyer. I had several uncles who were lawyers. And at some point around junior year, I actually registered for the LSATs. And my dad said, what are you, crazy? None of us can add. You do math. You should do something with math. And I switched it to the GMATs and ended up at the University of Chicago's PhD program.
Wow, that's fantastic. And I know, so you went to Wharton, Penn Wharton studying engineering and finance as well at Wharton. And I think, I don't know if they called the M&T program.
They did. It was the early days of the program.
It still exists and is a very well-known program that is a super selection program that students go through. And my understanding is that you also met your great longtime friend John Biner, who would go to Goldman Sachs, and you'd kind of meet up with later, and he'd go on to run the fixed income group at Goldman Sachs Asset Management for many years. You went on to Chicago for your PhD, and you studied financial economics under Fama. What was studying with Fama like? And it's just around, I guess, the 1980s. And what was Chicago like at that time? What was in the air at that time? And my guess is there were so many Nobel Prize winners at the time, and many of the so-called Chicago School were around at that time. And my sense is in financial economics side of things too, a good number of folks that intersected there as well. I'm curious, what was in the air when you were there?
It was an amazing time to be there. I think historically there have been a lot of amazing times to be at the University of Chicago studying economics or finance. But for me, I always point out that my entire career was in some sense a lucky break, because I got there in the late 1980s. I think I showed up in fall of '88, and that was basically just when Fama and French were doing their first paper on the cross section of expected stock returns. It was probably a working paper at that point. I don't remember exactly. I could be off by a year or so in my stories. I'm getting very old, but I was essentially there when what we'll today call factor investing, what we might call systematic momentum investing. I was there at the infancy, and there's always some luck to these things. And even when you look back, it's funny, terms like value investing, terms like factor investing, we didn't use those terms back then. Factor investing came much later. I'm pretty sure the first couple of Fama and French papers didn't call like their price to book factor value. I think that came later. But when you have some amazing teachers. Fama and French were co-chairs of my dissertation. I think you're sitting in John Cochran's office. He was on the outside committee of my dissertation. When you have these amazing teachers and they happen to be breaking ground on what will be probably the major field of academic finance for the next 20, 30 years, you got to consider yourself pretty lucky. So it was a pretty amazing place to be.
To be there at that time, I'm sure is incredible. Fama French factors are sort of new. Those eventually published in I think the JFE in 1993. I'm curious, who else was also crossing paths with you at that time? I think when we talk about momentum investing, Mark Carhart, a fellow Fama student, was their PhD student, Ray Winowski. I mean, these are all people that you hired later. But I'm curious, who else was there maybe at the time? Obviously, Fama was working with Dimensional Fund Advisors, David Booth and others.
Yeah.
But Dan Iverson, Manny Roman went through Booth in around that same time as well. I mean, did you know any of these other people that sort of also, like yourself, would go on to, if they hadn't already started them at the time, go on to start these massive, multi-billion-dollar asset managers?
Sure. Mark and Ray. Again, my memory's fuzzy. I'm pretty sure I knew Ray, and I think I knew Mark in the program, or at least I knew him through mutual friends. I mean, you're a PhD student. A few years into the program, you're not quite in all the same classes together, and I was a few years ahead of them. Mark and I have an intimate connection, not just hiring him, but the momentum factor that I wrote my dissertation on, he included in what became a 4-factor model when he analyzed mutual funds. So we have that connection. And later on in my group at Goldman Sachs, I hired Mark and Ray. Ross Stevens was 2 years behind me in the program. I think it was 2 years, and I was his official mentor. Somehow I agreed to do that. I didn't even know Ross. I don't think I mentored anyone else. But Ross has built an amazing business at Stone Ridge. So he was there. A lot of big name academics were still there. Merton Miller was still there. I didn't really know Merton until I went to defend or propose my dissertation. It's a scary time to meet Merton when you're presenting your dissertation. And it was amazing. I'm sure a lot of people have the same memory, but the finance seminar was like Tuesday late afternoon at the University of Chicago, and people sat in the whole U, and you were at the front, and on the far right, Fama sat, and on the far left, Merton sat. And Merton got into my dissertation and ended up being very good. It was nerve-wracking, but he liked it. But I'm going back and forth. It was like a tennis game where my neck was in trouble. At one point, Merton is asking a pretty hard question, and Fama is answering it for me because he's read my paper 20 times at that point. And I started to interrupt to answer it my way. And I had a moment of clarity, thank God, where I'm like, I'm not going to interrupt Eugene Fama as he answers the questions for me. So it was a pretty heady time to be at Chicago. Antti Ilmanen, who's one of my partners at AQR, was my year in the program. My two co-founders of AQR, John Liu and Robert Krell, were 1 year behind me in the program. And I don't think I met Bob physically there. I think I met him later on through probably John or Ross. But John and Ross ended up being my first two hires at Goldman Sachs, along with Brian Hurst, who was our analyst. And then Bob and John ended up leaving Goldman with me to start AQR. So it's fair to say Chicago was responsible for an incredible number of good things in my life.
That's fantastic. And I guess just to close the thread on sort of the Chicago years, like when you were presenting your dissertation on momentum, and I think this was maybe at the time when yourself and Sharon Tidman, when sort of momentum was on the left-hand side, the equation, and then I think Mark sort of brought it on to be one of the right-hand factors.
That's well put.
With the 4-factor model. Like, was there an aversion to that? I think of Chicago and Fama as sort of being very risk-based factors, and momentum never really squares neatly into this idea that stocks that have outperformed. When we say momentum, for the listeners out there that aren't familiar, momentum means stocks that have outperformed in the past 12 months are going to continue to outperform. Those that underperformed in the past 12 months are going to continue to underperform. I mean, that sort of doesn't really fit into the standard sort of rational factors of value and size that are the Fama French factors. Was there aversion to this, or in a truly Chicago iconoclast way, or were people get it?
It's a great question, because as I'm finding these things, and I should say Jagadish and Tipman deserve pride of place. I was probably only about 6 months behind them, which I will regret forever. But I think that we should say that I think they're the discoverers. I mean, people were trading momentum in actual Wall Street forever, but the academic kind of formal discoverers, I think my version of it was a better formation. I'll give myself that, but they deserve that. I was actually nervous about telling Gene, who I still today have trouble calling him Gene. He tells me to all the time, and it's Professor Fama. I'm much more comfortable with that. But I was nervous going to tell Professor Fama that I wanted to write a dissertation. It wasn't only on momentum, but that I was including this result in a fairly prominent way. I distinctly remember telling him I want to study price momentum for choosing individual stocks, and cowardly mumbling the second part, that it works very well. Because you're right. Instinctively, for any so-called factor, a factor is if you sort stocks or other assets, but we always think about stocks first. If you sort stocks on this characteristic, the ones at one end of the sort tend to outperform ones at the other end of the sort. For any factor that you believe works, there are always two possible explanations. An efficient market story, where the ones that are attractive on that factor are in some sense, as a portfolio, not individuals, riskier than the other ones. And therefore you get a return premium for bearing risk. The other is a market inefficiency explanation, where, it's not really a formal kind of measure of risk. It's a bias. People have an error they're making. Taking the other side of errors can still be risky in the short term, but it's not a so-called price risk. It's not correlated and covarying with some stochastic discount factor that we care about. You can come up with a risk or a behavioral explanation for any of these factors. The plausibility, I've always found, and I think the industry would agree with me, the plausibility of a risk-based explanation for momentum, it's pretty hard to swallow. It's pretty hard to swallow. I think probably also trying to appease curry favor with Fama. I think I called it the fool's strategy when I started. Just buy what's going up and sell what's going down. People have tried. I've never seen a very satisfactory, this as a portfolio represents risk. It has a bad left tail, but that left tail seems to be, if anything, a negative beta, not a positive beta. I've never seen a really good story for that. But I'm telling Fama, and I mumble the second part, and he hears me. He probably, actually, I think he probably made me repeat it once, but so I say, I want to study price momentum, and I find it works very well. And he pauses for a second, and this still had a profound impact on me. It was a very cool moment. He just goes, if it's in the data, write the paper, which is about as close to a religious statement you can get at a Fama. That man's respect for data, no matter what his prior might be, is extreme, and it's actually very a great role model. I think he'll be the first to tell you he never has liked that momentum works. I think he's called it the principal black mark on their kind of 3 and ultimately 5 factor models, but he doesn't deny the historical results. If it's in the data, Fama wants you to write the paper. So that was a scary moment, as you intuited that it might be, but it ended up being quite a warm and nice moment for me.
That's fantastic and amazing to hear about Fama. I'm curious. So you're a PhD student in your later years. Were you ever thinking about becoming a professor, or you just knew that you wanted to sort of apply all this to
No,
practice?
no. When I entered the PhD program, I assumed I was going to be a professor. Um, I got slowly seduced to what you might call the dark side. You mentioned my friend John Biner. I should explain why you mentioned him, because you also worked at Goldman Sachs Asset Management, where John ran fixed income for many years. He was much more junior in 1991 when John and a few other people I knew working there offered me a summer job. I was still a PhD student, and it was come for the summer, see what you think. I went there, I had a fun summer, and they said, come for a year, you can work on your dissertation part-time, see if you like it. And I did that. And at the end of the year, maybe it stretched to more like a year and a half. Um, I still hadn't really decided when, again, dumb luck. Any story that you think ends well, and I hope it's not the end of my story, but I hope it has gone well. Um, any story that has gone well has a lot of luck along the way, and I always try to be humble about that. PIMCO, the West Coast, most known for fixed income, huge, respected money manager, read the first piece I wrote in the Journal of Portfolio Management. It had the exciting title, Option Adjusted Spreads and a Steep Yield Curve. The movie version has yet to be made, but they liked the paper, ended up calling me and said, would you be interested in coming out and starting a quant group for us? And I did talk to them. They actually did offer me a job. And I was incredibly naively honest. I walked up to my superiors at Goldman and I said, I think I lucked into this, but I think this is what I want to do. I can pursue the academic stuff that I really have grown to love, and I can see if it works in the real world, which I found very attractive. And I will have to admit, I did notice that if it works in the real world, you probably make a little more money than a professor makes. And someone who says they chose Goldman Sachs over being an academic and doesn't kind of admit that was at least part of the equation for them is probably not telling the full truth. And the partners I reported to said, hey, we're looking to start a group like this. And to this day, I'm not 100% sure that was true, or if they were just really opportunistic and quick on their feet. I think it was probably true. I think there I got lucky again. This will really date the story because this did not end well. But I think Goldman wanted to start a group doing this, having really no idea what this group would do because of the then success of the hedge fund long-term capital. About 7, 8 years later, in 1998, that did not end so pleasantly. But they helped me out a lot in my life because Goldman, I think, was like, these guys are making a ton of money. They're academics, applying their stuff to Wall Street. Cliff, why don't you try to do that here? And we didn't do very similar things to long-term capital. But I told Fama in French, I think I'm going to stay and do this. This is perfect. Fama was not happy with my choice. He wanted me to go on the academic job market. And it still saddens me because I love Fama and I didn't want to make him, I didn't want to cause unhappiness. I do take it as a bit of a compliment that he was upset. If he thought I wouldn't be a good academic, he wouldn't have been upset. But I still remember his comment to me. I told him, I think I'm going to stay at Goldman Sachs and build this group. And he just goes, why do you want to stay and be a salesman? And it was a very Fama-esque comment. And I would never say this to Gene. If he hears this podcast, I'm saying it now. I was thinking, you guys work with DFA, right? You do this, and I'm just going to do it from over there. So there are points on a spectrum, but yeah, I saw the opportunity to pursue the academic stuff, trade it in the real world, and do really well if it worked.
Well, I'm just curious. I mean, like how Goldman was set up at the time. I mean, my sort of sense of things, understanding a bit of the history, is that Goldman was a big innovator at that time in the sense that there were people there like Fisher Black, like Bob Litterman, that were in the fixed income research group. This was sort of even before Goldman Sachs Asset Management came to be, I think, in the early 1990s. And I think that's kind of where yourself and John Biner and Charmin Masavarani and all these other folks kind of come in. But I mean, the fact that one of the sort of co-founders of the Black-Scholes, Merton model was at Goldman. We talk a lot about Black-Litterman optimization, still being used in portfolio management. I mean, Goldman Sachs, at that time was, a hugely innovative environment. It totally makes sense that, young Clavazis would want to work there. And to this day, you're still writing academic papers. So it never stopped you from doing research as well.
No, and that was a major attraction of it, the ability to fuse both worlds. Who was who and who was where is a bit complicated. Bob Litterman was on the sell side, not on the asset manager side at the time. He actually came over when I left to run my group, actually in a broader role than I had, to run my group, among other things, but he moved to asset management. I think as a direct response to myself and a few other of our group leaving. Fisher Black being there was some of the, again, dumb luck in my life. I got to spend a lot of time with Fisher. He was really a sounding board. He wasn't building models with us. I remember one time I was showing him one of our early models, and he kept calling it a DM model. And I kept thinking he meant Deutschmark, because there used to be a Deutschmark. And he actually meant, is it too data mined? And I didn't, he was using it as a shorthand. But Fisher was great. One of the Fisher stories I love is he wrote a paper that was quite critical of some of Fama and French's early work. And his first line of the paper was, Fama and French misinterpret their own data. I could be slightly off on that, but I'm getting very close. He only thanked a tiny group of people, including me, and from the bad luck of alphabetical order, I'm the first one thanked. I am not done with my dissertation yet for Fama and French. So I should have given them more credit, but I call up Ken as soon as I saw it, and I say, I gave Fisher some comments, but I don't agree that that you're misinterpreting your own data. And Ken was like, we know Fisher. Don't worry. Because Fisher was absolutely brilliant, suffered from less groupthink than anyone I've ever met. The Emperor always had no clothes for him. He's always willing to say it. But I will say 9 out of 10 things he said were a little, this is very disrespectful, but were a little wacky sometimes. The 10th one was brilliant and nobody ever thought of it, and it was well worth the price of admission. But that did scare me. But Litterman was on the sell side, came over after I left, though we did use a version of Black-Litterman in building our process. So yeah, there was a guy, Bob Jones, who doesn't get enough credit in the quant world. Bob was running a quant equity product. Again, I don't think we even called it factor investing, but doing a lot of the early stuff and some innovative new stuff of his own. And he was a very early practitioner of quantitative investing, and he was there. So yeah, it certainly was not even close to just me. I landed in a fertile environment.
That's fascinating. So my understanding is, like, you came in, you went into the summer, you're working on fixed income stuff for the most part, and then
the summer was fixed income. When I came back for the year, it was fixed income while writing my dissertation on what we would now call quant equity, including momentum, at night and on the weekends. That was
fixed income by day, quant equity by night.
Yeah, later, that was probably the hardest, craziest time of my life, except many years later, my wife and I had 2 sets of twins, 18 months apart, when I was building AQR. So that was a fairly similar crazy period, just with a different nocturnal activity. Instead of writing, laboring away at a keyboard at night, I was feeding and changing children. If my wife watches this, she's going to go, "You didn't change too many children." So I might not send this one to her.
That's too funny. So I guess it's fair to say, what was quant equities always sort of your passion, and that was kind of what sort of led them to say, hey, Cliff, we need you to start a quant equities group or a quant group in general, also maybe do quant macro assets as well. And then that was sort of the impetus for starting these two groups. I think one was called QE, one was called QS. And now I think it's still called Quantitative Investment Strategies years later. But that was sort of the impetus for that.
You're giving us all way too much credit. It was not that well thought out. it was thought out at the level I said before, that other people seem to be making money with academic stuff. Let's see if Cliff can build a group to do that.
Mm-hmm.
In fact, the way I remember it, for the first, I don't know how many weeks, we were kind of walking around a little nervous that we had nothing to do. We started a quant group, and it was, and to some extent, nobody had a real plan for what I think they thought I had one, and I thought they had one. And what happened, Bob Jones was doing the quant equity. We ended up doing a parallel effort, but we weren't going to touch that early on. He was doing a good job at it. There was a group run out of London, non-quants, active, concentrated stock pickers running a portfolio that had done well, but had hit a very rough patch. And I think we did the performance attribution on them, and it turned out that they were actually pretty good, at least ex post. The statistical validity of this, I have no idea if we had a T statistic above 0.5, but in the performance attribution, they had been good stock pickers country by country, and always in the wrong countries. So the first thing Goldman asked us to do was this macro question: can you decide where in the world to invest using these quantitative methods? I think I said, of course we can do that. Give us some time. And then our 4-person group got in a tiny room, and we said, how are we going to do that? I said, of course, before I had a clue. Embarrassingly, because I think it's kind of obvious what we did, it took a little bit, but within a day or two, we just said countries are just portfolios of individual stocks. This is childishly simple. If we aggregate up the numbers that people like Fama, French, my dissertation, had been building factors on, if we aggregate them up for countries, if Germany is double the price to earnings, price to sales, price to book of France, and has worse 1-year price momentum, you normally don't get that because they're negatively correlated factors. But if that do you expect Germany to do worse? And the answer, of course, was yes. This is a bit of a cooking show. I got the cake already baked in the back. I'm taking you through the steps, but I know how it turns out. And we built the tool that the active group did use. We ended up building it for stocks, bonds, and currencies using different factors, but they all were some version of value, momentum, or what we might today call a carry factor. What does it pay you if nothing happens? But we also realized pretty quickly that we can give advice to the active groups at Goldman, but we could also directly run money using these. So by near the end of 1994, Goldman Sachs seeded something called the Global Alpha Fund that used both the macro and our version of what Bob Jones was doing, that we ran it separately, of a quantitative equity model to run a series of long-short strategies, long-short country futures, long-short bond futures, long-short currencies, and then long-short individual stocks within many of these countries, all with a goal to be market neutral, very aggressively, targeting very high vol. And that grew into a lot of the things that we did.
It's an amazing history, and also just I think all the people that my sense you helped hire and bring in, people who are PhDs, many of whom, I think folks, and many of whom at the University of Chicago, at business school, I think Mark Carhart, Ray Aronofsky, I think, maybe Giorgio Sanz, there's also.
Giorgio was after me.
Okay.
Mark and Ray hired Giorgio when they took over when I left.
Okay. Well, then there's also, Don Mulvihill. He was a University of Chicago guy, as well. Built their big tax loss harvesting strategy, which is one of their largest strategies to this day, and many others, who came to lead the group. Afterward, think of Dorman Torfey, Gary Kropotkin, and others. I'm just so fast forward, I guess, 5 years later, the infancy of AQR. You started it in 1998. With John Liu, Robert Crail, and Dave Kabila. Some of these were classmates of yours, and were working at Goldman Sachs as well. And what was the impetus for starting AQR and going out on your own and starting something totally de novo?
80% naked greed, I think we did the math and said, as well as you can do at Goldman Sachs, if you build your own asset manager, you do somewhat better. Um, Again, it's very similar to me telling you earlier that going to Goldman as opposed to academia had something to do with how well you do. It's just being honest. I think 20% was an early recognition on my part that I don't always work and play well with others. That you can't say whatever you want at Goldman Sachs. You can't say whatever you want at AQR. Only I can. A company has to have some, if someone at AQR suddenly has an opinion that a product of ours isn't great, they absolutely should tell us that we should debate it. But if they went out and submitted a paper on it without telling us, that would be upsetting. And I knew I wanted to be the guy who could say and write what he wanted. Again, I'm not claiming some altruistic. I'm giving it 20%. The 80% greed was still there. But I think I pretty early on, even though I loved Goldman was very kind to me. I did well at Goldman. Realized that I was a guy who ultimately had to be on his own. And then David Kabiller, still co-founding partner, still my co-founder, still active today. He deserves a lot of credit. At some points when we've had tough times, I wanted to blame him. But on that credit, because he spent the better part of a year convincing me that if we left and it became a we, it could work. People would actually invest with us. Because I was not the as secure about this stuff as I am now. This notion that a bunch of people turning 30 could leave and attract capital, I had to be convinced of, and David did convince me.
Well, that's fantastic and so great to hear. It's amazing. I mean, AQR is amazing in how transparent it is in terms of its investment process, in terms of the factors that you're using, and it's amazing how many sort of public goods that you're sort of generating in doing research. And I think in many ways succeeding, Goldman Sachs Asset Management, just in terms of the amount of research and output that you're doing on factors and various things, and AQR has been a real leader in this respect in factor investing. Some of the biggest factors I think that you've been focused on, and as other investors have, value, momentum, quality. I'm curious, now in sort of the factor-based investing world, there's been a lot of discussion about what factors have the greatest sort of relevance and sort of staying power. AQR is also taking the lead on some new factors like low volatility, betting against beta as a factor. I'm curious, where do you stand on your favorite factors?
It's funny. This does not affect the weights we put on things. We've actually moved to a more systematic approach to weights that looks at in-sample, out-of-sample data. So favorites, I would be terrified that someone would think I'm sitting around, and just overriding all the data and saying I kind of like this one. But I've always thought two of the originals, which still matter. They don't matter as much as they used to because the models have grown. But the value and momentum stuff, I've often joked that it's almost a Rorschach test, almost a personality test. Someone is either wired to be a contrarian or to be a jump on the bandwagon person. And I can't test this, but I've always thought one of the harder parts of active stock picking is that these two things do really work. And it's hard to keep both in your head at once because you're wired for one or the other. All else equal, I'm wired to be a contrarian in almost every part of my life, sometimes excessively so. So favorite in maybe an emotional sense, I'm at core a value guy. I don't think, certainly not today. I think in the past I probably let me overweight it, maybe even a little too much. We've certainly moved away from that over time. But if I had to have a favorite, I also love the fact that value, can work for a host of different reasons. I think it was Ray Ball. I hope I have his first name right. who wrote a paper in the early days of factor investing, who pointed out that value is kind of a catch-all for expected returns. It can be behavioral, it could be risk premium, but for the same cash flows, if expected returns are higher, the multiple is all else equal lower. So the theoretical justification, no matter what the empirics. Now, value, of all the factors we trade, value is probably the most episodic, meaning it's not IID. It goes through some long periods of being in favor and long periods of being out of favor. I think that's probably part of why it doesn't get arbitraged away. After a lot of years marketing these things, I'm pretty good at turning a negative into a positive. But the harder something is to do, the more plausible it is that not enough people do it to make it go away. So there's always good and bad news when you say something is hard to stick with. The bad news is it's hard to stick with. The good news is that maybe why it doesn't go to zero. But I love momentum. I've never been as much a momentum guy, even though it's somewhat one of the things I'm known for in academia is being, after Jagadish and Titman very early in creating that. That is, again, more emotional. That's a matter of personal preference. I finally stopped about a decade ago, but for the first 20 years of doing this, I'd make the same annoying joke when people would bring me a trade that we were doing, and I'd look and I'd go, are you telling me we're buying more of the Japanese yen because it is more expensive than it was last month? Because that's what momentum does. And often that would be more important than a valuation in the short run. And someone would look at me, they got the joke at some point, very deadpan, and go, yes, that is what I'm telling you. And I'd be like, okay, I was just checking. Because, in some fiber of my being, it just, that would always just bug me. But being a value investor without momentum would scare me, because value does have its long, dark periods, as they said about Winston Churchill in the 30s, in the wilderness. Betting against beta is one of my favorite factors because the empirics are so strong and because the story is so beautiful. It's a basic CAPM story with restricted leverage, where leverage is people are either unwilling or it's too expensive to do, and it leads directly to low beta stocks, which really help you in a world where you lever the tangency portfolio. But if you're unwilling to do that, they're kind of orphans. And it's a very, very sweet story that shows up in the data very nicely. Profitability, one of the quality factors, I love because it's empirically so strong. I think it's one of the weaker theoretical stories. I don't have frankly, we'll do things for different combinations. We like to have both, but a super strong empirical story and a less strong theoretical or common sense even story, or vice versa, can still get you in the process. You'll get more of a weight if you got both. I'm actually dating myself. We've changed to a more systematic approach, so that's a little less true than it used to be. But I'm just gonna go with it. But you're asking one of my favorites. I love the empirical results in and out of sample of profitability. I've never liked the stories why you should get paid for buying more profitable companies. I've never seen anyone, and I don't keep up with the academic literature quite as much as I used to, but I've still not seen anyone come up with a great theoretical story for why you should get paid for that. Though it's so strong empirically in so many different places. It's past the out of sample test. So yeah, I have different loves and ones I'm a little more queasy about. But again, we don't let my loves and queasiness matter. I don't think we ever let them dominate, and we don't let them matter as much as they used to.
Well, I'm just curious a little bit about market time, or factor timing, let's just say.
Okay.
And you've, I think, always, and correct me if I'm wrong, I've always sort of seen you as a critic of factor timing a bit. And I'm just curious how investors should maybe think about periods where traditional factors like value underperform for over a decade or longer. Like obviously value in the US, has become betting against tech specific story, which, if you've been doing that for the past 15 years, it's been a very difficult thing. Obviously, you can do sector neutral sorts where you're doing, you still have the same weight that, the tech sector will have in say the S&P 500, but then you'll within each sector you will pick stocks that have the most value. So you'd still have the same overall tech exposure, for example, but you just would pick tech stocks that have the most value. What do you think about that? I mean, there's lots of stat arb people out there that are trying to time the market, sort of, and have various sort of market timing strategies. When you have a big crash in the S&P, your expected returns go up. I'm just curious what you think about factor timing, market timing in general.
You asked a ton of stuff in that question, and I'm not going to remember all of it. But first, on the industry adjustment thing, the sector adjustment thing, I think we were the first to do that. Myself and Ross Stevens wrote a paper in 1995, never published, but you can still find on the SSRN. And I think we get pride of place on showing that most factors, and I think value is particularly strong, do better if you do it within industries and don't take an industry bet. That the apples to oranges, to go to the extreme, comparing tech to a textile on price to earnings. Are you ever going to not be short tech? And can that be right to have a permanent bet? Momentum was the only one that had very similar power for both. And I think that's very intuitive because there's no measurement problem. Momentum is momentum. It's return. Value has a big measurement problem. Does this ratio mean the same thing for this industry as this other industry? So I do have to brag for a second. Value, the simple Fama and French definition, price to book in the U.S., I don't remember. It's on certainly more than a decade, probably like a 15-year drawdown. Versions of value that are global, which Fama and French do also, it's not a knock on them, and that use more measures than just price to book and don't take that industry bet. The longest we've seen, which have been quite painful, have been kind of 2.5-year drawdowns. Actually, you're in drawdown for longer than that, so you have to make it back. But 2.5-year negative periods made back in about that same amount of time, where multi-factor processes are often not nearly as bad. Remember, except if a client specifically wants one factor for some purpose they have, we're always trading a whole bunch of factors at once. So, the value drawdown, the simple version has been out of favor for a while. Though I wrote a piece defending it just a couple of years ago called "The Long Run is Lying to You." I mean, to most people, 10 to 15 years is an eternity. If you ran a practical investment product doing only this, 15 years later, only you and your mom are still invested, and your mom has asked for the redemption papers. She wants to know kind of what the rules are for when she can get out. But in real life, at modest Sharpe ratios, remember, if we're trying to achieve a Sharpe ratio, call it 1. And we have many, many factors in many, many countries. Each individual one can't be close to 1, or otherwise we'd be a Sharpe ratio of 5. So they're not giant. In any single country, one factor is not a giant edge. So when you do the math, a standard deviation event, if you're a 0.5, which is gigantic for a single factor, right? If you were 0.5 across tons of things, if you were 0.5, it takes less than a 2 standard deviation event to be down for a decade. So these things to a statistician are often much less shocking than they are to a real world person who has to go in year 9.5 and say, still down. The other thing is, one thing I do think we pioneer, I'm bragging a lot on this call, you're bringing it out of me, but during the tech bubble in 99, we released the first to publicly do this. You never want to claim you're really the first because we do things privately we don't write about. We don't publish everything. John, we only publish the things we think are mostly out there. So I got to give other people the benefit of the doubt also. But we wrote a piece trying to measure the long-term, not short-term, attractiveness of the value strategy and introduce this idea called the value spread that many others use now. And if you go back and look at the academic papers, all the early work were sorts, ordinal sorts that built a portfolio of the better and went short or underweight a portfolio of the worse. We asked the question, particularly because value was getting creamed for a year and a half. Okay, how extreme is it? And to our knowledge, at least publicly, again, we were the first to say, all right, pick your favorite valuation ratio. We looked at multiple ones. If you like price to sales, what's the price to sales of the cheap portfolio compared to the expensive one? Is it more different than it normally is or tighter than it normally is. And the idea is when there's bigger differences, when the expensive ones are at a much higher multiple than the cheap ones, than normal, they always look more expensive, right? You created the measure, you sorted the stocks. If you sort on something, the ones that are higher will be higher. But how much higher varies through time. And we did find that if you have a long horizon, 3 years is good, 5 years is even better, that there is some power to it. When that spread is larger, things go on. The value strategy will do better. When spreads are tight, the Sharpe ratio is lower. We also found, and here's an example of publishing. I'm still a little bitter about this one. An official AQR publication strategy is the perfect AQR publication strategy. Is you discover something you think no one else knows that has some alpha. You trade it for a decade and you write a paper on it a minute and a half before someone else is going to write a paper on it. Because it's going to be out there anyway, might as well get the credit. Obviously, that's art, not science. And we've been trading the fact that factors themselves have momentum. They tend to trend for many years, and someone else wrote the paper, and I was very angry that we missed that one. We let someone sneak in before us. But that matters too. In the short run, fighting momentum is always a problem. That this result repeats again and again and again. So never bet your life on factor timing. It's still, particularly on an individual factor, pretty low risk adjusted return. But the perfect time to like any factor is when it looks quite cheap versus history, but when the last 6 to 12 months are starting to look pretty reasonable. You never, like any value plus momentum strategy, you never nail the peak or the trough because you need to see it start to work. But because trend following is real, that's a higher Sharpe strategy. And when I've messed up in this field, it's when I found the valuation so attractive that I've said, we got to do a little even before the trend turns. Turns out the trend has tended to still have efficacy. So I do think you shouldn't do much factor timing. I think most of your factor timing should actually be trend-based, not valuation-based. And valuation only gets interesting when you're at something I jokingly call the 120th percentile. You're a guy who will understand. Sometimes I make that joke and people don't understand there is no such thing as the 120th percentile. I mean, like wider than you've ever seen before. But mostly don't do it. And to be totally fair, the times I've been most cynical about factor timing is when one of my frenemies, Rob Arnott, is very, very into it. Somehow when he writes something, I instinctively take the other side too much because Rob's a brilliant guy. So I have been a little schizophrenic on factor timing. Historically, we've not been flighty in the portfolios. We've always done a little with some valuation and particularly trend following. Factor trends are just, we think they're real.
Yeah. Well, I'm curious just maybe lightning round through a few of these topics that you've spoken a bit
Fire
about.
away.
One is, in academia at least, there's a bit of a replication crisis, and factor research has, I think, suffered a bit in academic finance, and it's not being published as much anymore. And I think a big question is, what are the real factors, and to what's really p-hacked, what's sustainable, and maybe when a factor is discovered, it's arbitraged away and people pile into it. I'm just curious, what you think about factor research and how do we sort of just over time build an understanding of what are the essential factors in the structure of asset prices?
Sure. Again, you ask questions that I could not do a lightning round. I can go on for a long time. The literature well. It's actually how big the replication crisis is in factor investing is a contentious topic. Lasse Peterson, Brian Kelly, and they work with me, so I think they had co-authors, so I don't want to imply it was just them. They take the view in their paper that the replication crisis is not that bad. For one thing, I think some people hold replication to too high of a standard. Literally for close to 30 years, as a rough rule of thumb, we've said if we get half a back test going forward, we'll be thrilled because we know there's some p-hacking and everything. I mean, obviously, there's some things you might want to discount more, some you might want to discount less. Not saying it's a be-all, end-all, Half is a pretty cheap and easy, kind of wimpy guess. How many times in life do you just split the difference? But for at least we've been consistent in our wimpy guess. That changes what you think of as success or failure by a lot. Against that standard, we find the results are fairly reasonable. I think value plus momentum has been about half of a back test since we've started looking at it. So we don't think it's quite that bad, but obviously data mining, p-hacking, overfitting is a perennial issue. When it comes to which factors are easier to arbitrage away, I think the hardest ones are ones, again, like the value factor. That's based, I think, on basic risk or behavioral reasons, and I've drifted more to the behavioral side over my career. I think it's just proximity to Fama. Being away from Fama, I drift, and if I walked into his office, I'd probably snap back into the risk side, being a total coward who loves the man. But factors say value is based on behavioral errors people make. That means they're pretty deep behavioral errors. Over extrapolating good and bad times, overpaying for them. Also, value, as it's shown us, goes through long periods of pain, even if it pays off long term. Like we discussed earlier, that can make something very hard to arbitrage away. That could be bad news to someone living through it, but good news to whether it's going to be around for as close to forever as you can say in this business. Factors most susceptible to being arbitraged away are legal information advantages. When I say information advantages, I'm quite careful to please AQR compliance and throw in the word legal. But if you've built a data set, and nowadays people call this alternative data, and we're actually fairly into it. We certainly do this. If someone builds a new data set and is only going to sell it to one or two managers, and that itself is a very interesting negotiation because you have to decide if you think it's real. They charge a lot more than traditional data because they're only giving it to one or two managers. But you don't expect to trade this for 20 years. It's an informational advantage. It's, you're looking down through a satellite. You're doing a credit card summary of what's going on in the real world, and you have an edge for a while. But any factor that's about speed of getting information and acting faster than other people, and unless you're the fastest in the world, which some people do try to be, that is probably not even close to a permanent edge. And everything is on a spectrum.
Absolutely. Okay. Next question: how has machine learning changed, if at all, how your systematic approach to investing at AQR works?
Well, it's creeping in is understating it, but it is starting to show up everywhere. And I'm nervous saying this because I've said this publicly, and the financial press has picked it up and overdone it. I've said that I probably slowed us down by a couple of years in machine learning because I was a little cynical. We've always told this story, like I was telling you, that we care about both data and story. And when you move into machine learning, you got to lean more heavily on data. It's kind of the point, right? You're not telling a story. You're surrendering yourself, if anything, a little more to the data. So I've had a couple of headlines like Asness does flip-flop on machine learning. That kind of stuff drives me crazy, of course. Like anyone in business is driven crazy, sometimes by the press. We invested a lot in machine learning when it was all on the arm, when we didn't know if it would work. We hired Brian Kelly out of Yale, one of the major machine learning, and I'm biased, but I think the top machine learning guy in finance. We explored and built machine learning in our existing funds. People like Andrea Frazzini, Laura Serban here. So we were not so cynical that we didn't pursue it. I just had smaller hopes than maybe some others did because I was so used to this world of being more worried about overfitting than anything else. And one thing machine learning does is it deals with very complex problems with more parameters. This is quite controversial right now in academia, and I will not try to do Brian Kelly's job because I'll do it horrendously badly. But his paper, The Virtue of Complexity, arguing that ML changes the equation on how many parameters you can have and the dangers of overfitting versus underfitting. I think Brian's right, but if I try to, I'll lose the debate if I try to do it. But it is changing how we do things. There are factors where we usually can still get some intuition out of what's going on. I think there are pure ML players that just throw away all intuition, and I don't think we've quite gone there. But has ML moved us more towards the data? I got a question once, I never thought of it this way, from a client about an ML factor and saying, can you give me a precise, intuitive explanation of what it's doing? I can give you a very imprecise one. But if I could be very precise about it, what is it doing? Where's the machine learning? What is it doing if I can just give you a off-the-cuff, easy one-line answer to it? One of the prime areas where ML has helped so far is processing natural language, being able to tell if something is good or bad news. And quants have done this for a million years. The old-fashioned way to do it is to build up keywords and phrases and assign numerical scores. Way oversimplifying. Do you see the word increasing? +1. Count up all similar words, and of course you immediately see the problem. If the actual sentence was massive embezzlement is increasing, +1 was probably not your best guess. Now, quants can survive looking silly 47% of the time if we get it right 53% of the time. So I'm not knocking this old approach. I'm just saying it's very noisy. It turns out that applying natural language processing to language data, language is a very nonlinear thing. Whether a certain word is good or bad might depend on this sentence, like the simple one I just gave, but it might depend on 3 sentences ago. Nothing is perfect. Language is very complicated, but it turns out NLP applied to textual data to forecast returns, we found to be very powerful, and we've had some great success with it. I can tell you in general what it's doing. It's doing a fundamental form of momentum or good things happening. But can I tell you precisely why it likes this stock? I cannot. And when you do ML, you often have to give that up. Or again, what the heck is the ML doing?
Mm-hmm. So next question's private markets versus public markets.
We're shifting gears.
I know you're a big public markets guy, and also a bit outspoken on making comparisons between public markets and private markets. Obviously, private markets, just in terms of assets, have totally exploded in recent years. Do I understand this right, that when you talk about so-called volatility laundering and making the how you can't really compare public market returns to private market returns, is that the issue is that with marks, how private markets do marks is that how they value themselves. It's not just a frequency issue in that public markets you have every tick that's traded in public markets, but it's a quality of marks that these firms, say private equity firms, are valuing themselves, and there's a bit of a bias in terms of how they value themselves, and that kind of distorts volatility and return metrics a bit for private funds, say private equity funds, comparing them to say public funds, publicly traded funds.
I'll give you a short version of my complete private equity story. First, the term volatility laundering, which was mine, I feel kind of bad about because it's pretty snotty. And I'm not really implying anything illegal is going on here. I want to be clear about that. But laundering is when something doesn't show up that's there. And the way my sense of how most privates are marked is, let's go to 2 extremes. You can mark any asset at one of 2 extremes or anywhere in between. You could mark it at where you can sell it at today. And even that has some issues. What if I tried to sell a ton of it today? Maybe you get a lower price, but you know what you're trying to do. And for public markets, that's quite easy to do. You look up the price and you mark it there. The other end of the spectrum is you can mark it at what you think it's worth. And that's not illegitimate. That's an interesting thing. My sense of the way where privates do is much closer to where they think it's worth. I think if markets move, they factor that in a little. I don't think they run to a zero beta, but they're mostly marking to their model, to what they think the thing is worth. And I don't object to that if I get to do it too. What I object to is different standards. And then the worst thing is when these are mixed and people will show an efficient frontier using market prices for public assets and what the private people think it's worth prices for the private assets. And you'll see this. You'll see some investors put out their assumptions, and they'll draw them on the efficient frontier, and they'll have like public equities at 16% vol with an expected 10% return, private assets at a 5% vol with an expected 14% return. You could debate the 14 versus the 10, but the 16 against 5, I think that's what I said. You cannot debate that. That's just not apples to orange. That is apples to oranges. And it pisses me off because I got to live in the standard of what the market will pay me. I am just as capable of telling you what I think our portfolio is worth. When we started AQR, I mentioned before, right before the dot-com bubble of the late 90s really took off. And we were down a lot before we did very well. Well, if I marked to what I think my portfolio is worth, I would have said all these tech stocks that were short, I don't think they're worth this. So I'm going to market to what I think I'm worth. And if I tried to tell my clients, actually, we're up a little bit, I think they would sue me because they would say, no, you're not. Look at the prices. And what I don't get is the private people can do exactly the same thing. They are the world's best people at valuing a company. They could tell you where I could sell it today just as easily as they could tell you where their model is. And for some reason, they get to do it one way and I get to do it another. And that part of the story, I am certain of, that their risk is much higher than you think. If we go through a 10-year bear market, that risk will show up. And that's pretty much all you really worry about is the giant bear market. So I do think they're understating their risks. It can even matter for prospective returns going forward. Because imagine, and I find this very easy to imagine because I think this is actually what's going on, but imagine a lot of investors have grown to value this volatility laundering. It's easier to stick with if you don't have to deal with the real current mark-to-market prices, right? The public markets are way down in 2022. Privates are only down a little. Easier to stick with. Well, in the early days, when David Swensen at Yale was pioneering using privates for institutions, it was pretty easy. And his book, Pioneering Portfolio Management, talks about this all over the place. It was particularly easy to say you get paid a premium for owning the illiquid private asset because who wants something not marked to market that's hard to sell? Well, imagine today, and again, I think this is actually, at least to some degree, what's going on. Imagine today that is a desired feature, not a bug. That not having to mark to market and not having to report the full volatility is a good thing. Well, you pay up for a good thing. You accept you demand a higher expected return if you have to take on a bad characteristic. You accept a lower expected return if you have to take on, if you're forced to take on, or if you take on a characteristic you want. So I think it can actually affect the expected returns going forward. I would not expect, I won't tell you what I think it's going to be. It's all over the place. But whatever premium, and this is fought over because private data is private data. We don't have the best apples to apples comparisons. But whatever the past has been, my strong guess is privates will not enjoy the same advantage over public going forward because what used to be a bug is now a feature.
Mm. That's
and I live in Greenwich, Connecticut, and I got to be careful if I go near a golf course that people won't aim at me.
It's too funny. Yeah, there's a lot of private equity folks out there now, increasing number of them.
Yes, the old cliche applies to me. Some of my best friends are private equity managers.
It's that's too funny. I hope they're still kind to you. I want to sort of my last question or two here for you is really about your investment philosophy. And I remember when Fama and Shiller both won the Nobel Prize in 2013 along with Lars Hansen. It was, I think, a pretty seminal moment. And I mean, in part because they were giving a prize to both Fama, who is sort of the standard bearer of the risk-based efficient markets view, as well as Robert Shiller, who is really the standard bearer of the, I would say, very behavioral finance view. And I've always felt that you're somewhere sort of in between. You recently wrote a paper titled The Less Efficient Market Hypothesis. I'm curious what you meant by that and what your kind of broader view is.
Let me start out by saying Fama should have won a solo Nobel Prize 10, 15 years earlier. than that. I'm still a little bitter.
Well, they could still give him a second prize. I mean, you could lobby for that.
I don't know how often. I don't know if that's ever been done, but I know in the sciences people have won in other categories.
Yeah.
But it's going to be hard to get a second one in economics, I think. So I think Fama revolutionized the field. The efficient market hypothesis, no matter whether you believe it's close to holding or not, is kind of the firmament we start with to test everything. So, I think he's the MVP of modern finance. With that said, making up numbers. I was never a pure behavioralist. Remember, I wrote my dissertation, a big part on momentum, which is very hard to reconcile with risk-based explanations. But I was probably 75-25 Fama French risk-based, and I'm probably 75-25 behavioralist at this point. The real world smacking you in the head, living through multiple things where I would use the word bubble. I'd use the word bubble about early 2000. I'd use the word bubble about late COVID, late 2020. I don't use that word very much. I still use it a lot less than a fair amount of active managers. Twice in a career is not, I think, too abusive. But Gene don't like that word. So the less efficient market hypothesis was really a 20-page op-ed. The Journal of Portfolio Management had its 50th anniversary, and they invited some of us who've been publishing there a long time to write papers. And invited papers are awesome because they're not refereed. So you have you give a lot more latitude. Frank Fabozzi, the wonderful publisher there, I think he would do some quality control if I submitted something insane, but it's not quite the same. He encouraged us to muse a little bit more. It was supposed to be like an old men reflecting on what they've learned. And I do think over my career, I have moved on this, and I think markets have actually changed somewhat. That value spread thing we described earlier, the spread between cheap and expensive, by March of 2000, the dot-com bubble hit levels that were not close to anything in 50 years of history. When the next 2 to 3 years happened and we made way more than all that money back and life was good, if you had said to me, are you going to see something as crazy in your career again? I hope I never would have promised anything, not just for legal reasons, but for intellectual reasons. Never say never. But I think I would have said very, very unlikely. For one, it was the biggest in 50 years. As much as I'd like to live forever, I don't think I necessarily have a 50-year career. Two, your question presupposes I and others like me will still be around in your career. And we saw this. And then by the end of COVID, it was getting close before COVID, so I can't blame COVID for the whole thing. By the end of COVID, by late 2020, it was substantially wider a value spread as we measure it than we saw in the dot-com bubble. So if that doesn't make you go, has something changed versus history over the last 20, 30 years? And I have a few hypotheses. I know you're very, the inelastic market hypothesis, how that affects indexing and whatnot. The growth of indexing could matter. I am not someone who thinks the growth of indexing is the worst thing that's ever happened in the world. There are a fair amount of people who are, I think, a little hysterical about it. But we all know that the classic kind of finance, brain teaser, what if everybody tried to cap weight index, is gibberish, right? There's literally nobody thinking about prices. It's hard to believe we jumped to gibberish going from 99.999% indexing to 100. So the fact that we have a lot more people cap weight indexing and a lot fewer people looking at companies, could that matter for this? Could that let prices drift further? I don't have a formal model, but yeah, I accept that. My favorite hypothesis, and I stress the word hypothesis because nobody knows, is I'm going to really sound like an old man yelling at clouds now. But the social media environment, 24/7 gamified trading. I think most people of any political persuasion, won't say everyone because we have a lot of people with some odd views these days, but I think most people would probably agree that this environment has made our politics worse. It's pushed us into bubbles. Its confirmation bias has gone way up. it has made herd mob behavior easier to get going. Markets are voting mechanisms. They're not arbitrage mechanisms. They're voting mechanisms. The old Schleifer-Vishny limits of arbitrage said, no, it could be an arbitrage, but if you can't hold it, it doesn't last. If somebody is making an error, Fama French wrote a paper on this too. If somebody is making an error, you take the other side of that error, but not enough to arbit to zero. Because the early part of taking the other side makes you a decent expected return and low risk. But as you keep adding that to your portfolio, you're closing the gap and the expected return goes down and the risk goes up because you have to own more of it. So if the world makes net errors, as Fama and French say, and I'm paraphrasing, unless errors miraculously balance each other, prices will be set in a vote, in a dollar-weighted vote. So I find it very hard to believe that this environment has made our politics much worse, but a voting mechanism called the market has been immune to it. I could be cheap and point to the meme stocks. I think they are a extreme mutated example of what I'm talking about. But I think it has made the idea of mispricings, even if they're not all the time, occasional large mispricings from mob behavior, much more plausible to me. Sorry, go on.
There's this question about quantities, right? So I think it's very much integrated into this, where right now there's in academic finance a big debate happening, and you mentioned this about the role of quantities, and what do we mean by that? It's if you hypothetically had $1 billion on the sidelines in cash that just went into the stock market, what would the effect of that influx of cash of say $1 billion? Would it be a permanent increase of $5 billion or a multiplier of 5? And that's kind of what the very behavioral folks like Xavier Gebex and Rolf Koyen argue in their new paper, Inelastic Markets Hypothesis. It's called the Inelastic Markets Hypothesis. Some people would argue it's a bit less. There was a paper in the 1980s by Andre Schleifer that does the demand curve for stocks slow down? I have a tongue-in-cheek paper called the Elastic Markets Hypothesis that argues it is somewhere in between, probably similar to yourself. But there is this question about what is the shape of the demand curve for assets? And in efficient markets world, I think I would say it's sort of perfectly elastic, very horizontal. And in that sort of Fama world or modern finance world, information was key. Arbitrageurs were key. But it seems like
price is expected discounted cash flows, which doesn't move with a trade.
Exactly. And it seems like this kind of, say very behavioral vision of very inelastic markets is almost going sort of pre-modern finance where everything was about supply and demand. And I'm just curious what you think about how quantities work. I mean, AQR, I'm sure, spends a lot of time thinking about market impact of trading, transaction costs. There's this famous 3/2 model or quadratic model of market impact out there. I mean, how do you think about quantities market impact? Is it a short-term thing and things revert, or is it a permanent thing in the same respect that Gebex and Koyen argue there's this 5x multiplier that's kind of a permanent thing? How do you think about that?
Okay, it's your fault again that it's a 9-part question. First, full disclosure, I think the world of Ralph Koyen, we gave him an award for the Inelastic Market Hypothesis paper because we used to give out an annual award. And he is actually the AQR professor of finance at the University of Chicago. So with that said, I am, as you predicted, closer to you on this. I'm my guess, and it really is a guess. You're closer to the academic debate than I am. My guess is it comes out that markets are certainly not perfectly elastic. Eugene Fama, when it comes to the efficient market hypothesis, something like second week of class, he tells you markets are certainly not perfectly efficient. And the class gasps because they're at Gene Fama's class at the University of Chicago. And he looks at him like, he doesn't say this because he's a very nice man, but he's like, what are you, idiots? Perfection is a stupid hypothesis. The real world isn't perfect. So I'm going to guess some of it holds up. I'm going to guess some of the critiques that are coming out bring those results a little back towards the middle. But one thing I stress is I make very little of my living based on market direction. I make it much more based on stock and other asset selection. We do macro also, but thinking about just stocks, much more of my life is about 1,000 to 1,500 stocks long, against 1,000 to 1,500 stocks short. And the idea that that is highly inelastic is far less plausible than the market. We can debate the market, but the market has few close substitutes. Mm-hmm. And you can't have, if you have few substitutes, it's at least plausible to be somewhat inelastic. But if you have a lot of close substitutes, I think it gets very implausible. And individual stocks have tons of close substitutes. So I have not seen, you probably are more familiar with the literature, any paper claiming that individual stocks in say a market neutral trade are highly inelastic. Have you?
Well, I don't. I think the claim that
it's a Haddad paper that has something along this line.
There are some that have tried to push the inelastic markets hypothesis thing beyond just sort of macro assets, which is I think the original sort of Rafal-Cohen argument that it may exist also in at the stock level. But I'm skeptical of claims about either.
Yeah, but and when it comes to market impact, first of all, it's very real. If you assume zero market impact, you way overestimate what you'll make from any model or active process. But when it comes to reversion at the individual stock level, one stock against another, I think most of market impact is not permanent. Mm-hmm. Because again, being close substitutes, I don't think it moves prices to the same extent. And it would be kind of weird if the prospects of one stock against another were permanently altered because somebody put a trade on one day. You can imagine the market has to absorb that. A lot of people, which is not us, make their living from so-called statistical arbitrage, even going into the high-frequency trading world. And a lot of that is about what tends to trend and what tends to reverse at the short term. And again, this is not my world. I wrote a paper that was very close to state-of-the-art stat arb in 1995. And I've been told this by stat arb people, and it's my fifth story. Every fisherman has the one that got away, the big one. And I looked at it and said, doesn't cover T costs, and moved on. And it did ultimately, if you kept that, it covered T costs. I should have kept with that one. Big error. But I tend to think most of the market impact we look at is relatively short term. And the jury, I think, is still out on market-wide market impact. Even there, I find it hard to believe you get a forever change in price. Mm-hmm. But can it last longer? Is it harder to take the other side? The plausibility of the Koijin et al. Story, which he only has one co-author, so I shouldn't say et al. But I can never pronounce the name right.
Get back. It's French last name. Yes.
We don't mean this meanly or a wonderful researcher. The plausibility of that story, when he says how many people will take a market bet, we tend to run most things to a zero beta. So if somebody wants to go long extra stocks, we tend to mostly, I won't say completely, mostly not be the people who take the other side of that. So then, a lot of funds are wired to do that now. So the notion that some of that, maybe again, full permanency, I just instinctively find hard to believe. But the idea that is far closer to permanent, that lasts much longer, I find that plausible. The market-wide argument, which I think is where most of this is occurring, is mostly spectator sport for me. I don't think it affects very much what we do, but I will be watching to see which one of you guys ends up winning.
Mm-hmm. Mm-hmm. Well, yeah. Well, I feel like there's some similarities with the less efficient markets hypothesis and the elastic markets hypothesis. Things are almost efficient, but not perfectly efficient, and there's some things that are behavioral out there, but not a ton. So maybe we'll take that tag team for the win. Cliff, I really want to thank you for coming on. This has been an amazing conversation.
Oh, I really enjoyed it, John. These were fantastic questions, and thank you for having me.
This is the Capitalism and Freedom, the 21st Century Podcast, an official podcast of the Hoover Institution Economic Policy Working Group, where we talk about economics, markets, and public policy. I'm Jon Hartley, your host. Thanks so much for joining us.